Hey, everyone, and welcome. Thank you for taking the time today to join us for the webinar, Hot Topics for Cross-Border Tax Requirements in AP. My name is Anand Misra, and I'm the Director of Product and Partner Marketing at Tipalti. Just a few housekeeping reminders before we start. There is no dial-in for this event, and the audio is through your computer. Please submit your questions via the Q&A section, and we will cover them towards the end. If we are unable to get to your questions today, we will ensure that somebody from Tipalti will get back to you with a response within the next couple of days. And for optimal viewing, the slides and the screen share views can be adjusted to your console. I would also highly encourage you to look at the Resource Center for more content from Tipalti. Lastly, we would appreciate your feedback, so please complete the survey before exiting the event. If you're interested in receiving one CPE credit for today's webinar, please ensure that you meet the following 3 criteria. You have to watch today's webinar for 50 minutes. You have to complete all 3 polling questions. You have to complete the course evaluation, which is referred to as Pass Test in the webinar console. You can access the course evaluation by clicking on the icon in the toolbar at the bottom of the webinar console. We will keep the console open for around 10 minutes after the end of the webinar to give you enough time to complete the evaluation. So let's kick it off. We have today Laurie Hatten-Boyd, Principal at KPMG's Washington National Tax Practice. Laurie also heads up KPMG's Tax Information Reporting and Withholding Group. Laurie is a subject matter expert and a thought leader and engages in a wide range of withholding tax advisory services, assisting both financial and non-financial institutions in complying with their U.S. tax information reporting and withholding requirements. Laurie was acknowledged as one of the top 10 prominent people in tax. She was also nominated by Tax Notes Today as 2011 Person of the Year. Prior to joining KPMG, Laurie was an attorney advisor with the IRS Office of Associate Chief Counsel International, where she worked exclusively with Section 1441 withholding regime. Laurie is a frequent speaker on foreign withholding issues and has authored articles appearing in International Tax Review, International Law Journal, and The Tax Lawyer. And Laurie is also a member of the Washington State Bar Association and has a JD degree from Gonzaga University and an LLM in tax with distinction from Georgetown University Law Center. So welcome, Laurie. And I'm Anand Misra, Director of Product and Partner Marketing at Tipalti, where I'm responsible for driving messaging, positioning, and product launches. And prior to Tipalti, I was the Director of Product Marketing with Oracle NetSuite, a leading cloud-based ERP solution. And I have over 17 years of product management and product marketing experience. So with that out of the way, I would like to welcome Laurie. Laurie, the floor is yours. Take it away, please.
Thanks, Anand. So there's a couple of things we're going to talk about today. First, we're going to just go through the mechanics of Section 1441 and those withholding rules and talk a little bit about the IRS's compliance initiative in this space. Then we're going to go over some of the common misperceptions with Forms W-8 and W-9. And then we're going to wrap up at the end with Form 1099 non-employee compensation, that new form that's used to report those types of payments beginning for the 2020 year. First, we're going to start off with a polling question, and that question is, when do you collect tax forms from your suppliers? So is that going to be during the onboarding, before a payment's made? You try to collect during onboarding, but sometimes you're unable to, and the payment's made at year end when you prepare the information returns, or you don't regularly collect these tax forms. I'll just give you a few seconds to answer that. Hopefully everybody had a chance. And here we've got the results, and that looks great. Almost 70% of you are doing that up front before the payment's processed, and that's exactly what you should do. And the rest, nearly the rest of you are trying to do that, so that's fantastic. So as I said, we're first going to talk about Section 1441 and what these rules really mean. So our starting point here, we've got a FDAT payment that would be fixed, determinable, annual, or periodical payments, and we'll get into that in detail in just a moment. And on the left side of this slide, we've got FDAP payments going to U.S. persons. And here there's the potential for Form 1099 reporting and 24% backup withholding to the extent you don't have the payees TIN in the manner required. And the reason I say that is not all payments require a Form W-9, even though we do feel it's best practice. But for most vendor payments, you just need to get the TIN, and it doesn't need to be a certified TIN, meaning it doesn't need to be provided to you under penalties of perjury. The 1099 reporting, if the payee is a U.S. non-exempt recipient, so individual, partnership, estate, trust, that's going to be issued a copy to the Internal Revenue Service, a copy to the recipient, and then the IRS matches that up on the payee's tax return to make sure that they've properly paid that tax. On the right side is what we're really going to focus on today, and that is the FDAP payments going to non-U.S. persons. Here, if it's U.S. source, we only care about U.S. source. For the payments to non-U.S. persons, we would be capturing both U.S. and non-U.S. source income. Here, there's a statutory 30% rate of withholding on U.S. source FDAP payments made to non-U.S. persons, and then there's abilities to reduce that either under an Internal Revenue Code exception or an income tax treaty. But you need to have the proper documentation, which we'll go through in detail. Here, the reporting is on a Form 1042-S, which is just the non-U.S. equivalent of a domestic Form 1099. Again, copy to the IRS, a copy to the recipient. If there was a treaty claim on that, the IRS exchanges that information with its treaty partners. So again, we said we're talking about U.S. source FDAP payments. The character and sourcing of the payment is the responsibility of the withholding agent. So it's very important that you've got processes in place not only to collect the tax documentation that we just talked about in the polling question prior to making that payment, but determining the character and source of that payment. Because if it's U.S. source and subject to withholding, you want to make sure that you're able to do that before you let that payment go. It's very hard to remediate these things after the fact if you make a payment gross and it really needed to be subject to 30% withholding, unless it's an ongoing vendor and you can make up that withholding from future payments. It's hard to get that money back. And as with any of the withholding rules, as the withholding agent, if you fail to impose the correct withholding, you're going to be liable for that withholding to the IRS. The year-end reporting here, the tax return is a 1042. The information return, as I said, is a Form 1042-S. These are due on the March 15th, following the calendar year that the payment was made. The 1042, the tax return, can get an automatic 6-month extension by filing a Form 7004. You can get an automatic 30-day extension on the Form 1042-S. The IRS copy is extended by filing a Form 8809. The recipient copy, it's a different process. The process used to be a letter to Martinsburg. The address was in the instructions to the Form 1042-S. Very recently, they changed that to a fax number because of the COVID, that nobody's in the office there, and so they need the fax. We don't know if that's going to be permanent. That's why I left both here. So you'll just want to check the instructions to the form to see if they're going to go back to the address once things get back to normal. So why care about all this? We care right now because the IRS is really actively pursuing this. They had always had continual audits for the large financial institutions that were making cross-border payments on U.S. securities, so those interest and dividends. But in the non-financial sector, the IRS had for years said that they were putting together an audit initiative, but it just never happened. And just in the last 18 months, I would say, it's really materialized. And we're seeing these exam teams across the country, there's 9 different territories, are initiating these exams. Even with COVID going on, we're still seeing them sending out those initial letters saying that the taxpayer is under audit. So it is something that's very much on their focus or radar screen, and they are particularly focusing on accounts payable functions. So because they care, that's why we all care. So just going back to the mechanics, what type of payment? It's that fixed, determinable, annual, or periodical payment. So that's really any type of payment, with the exception of gain from the sale of property. So when you're just buying inventory or whatnot, that's going to be excluded. market discount, and option premiums. So you're really looking at personal services income, royalties, rents, directors' fees, prizes, awards, things like that. I had said gains from the sale of property is excluded. The one exception to that is if you're acquiring an IP right, an intellectual property right, and the sales price is contingent on the future use, that is going to be treated as a royalty, and so would be subject to the 30% statutory rate of withholding unless there's a treaty that's going to reduce that rate. So the source of the payment, if you can't determine the source at the time you're making the payment, the regulations require a presumption that it's U.S. source. And I've got an example here where there's a prepayment for services, and at the time of the prepayment, you're not sure where those services are going to be performed. You would have to treat the entire amount of that payment as U.S. source, and then if there was a refund, the beneficial owner of that income would have to file a tax return and claim the refund for any services that were actually performed outside of the U.S. Documentation is really the cornerstone to the 1441 regime, and we'll go into each of the various types of documentation. But that documentation is going to help you as the withholding agent know, am I paying a U.S. person or a non-U.S. person? Is it the payee or the beneficial owner? And we'll get to that distinction. And then the classification of that payee or beneficial owner. Is it an individual? Is it a corporation? Is it a partnership? And then the documentation will will allow you to determine whether a reduced rate of withholding is permissible. And as you can imagine, the regulations cover all the scenarios. If you don't have the proper tax documentation on file when you make the payment, there's mandatory presumption rules that you would have to apply. And the IRS was very careful to make sure that those presumption rules would result in the maximum rate of withholding. So just now we're going to do one more polling question right now. Which tax forms do most of your suppliers submit? Is that a W-9, a W-8 BEN, a W-8 BEN-E, or none? You're located outside the U.S. I'll just give you a little bit of time to answer that. That was an easier one. I won't give you as much time as the other one. And it looks like the vast majority is the W-9, which is exactly what I would expect. So just moving on, I'll discuss each one of these forms and when you would be expecting this from the vendor that you're dealing with. So first we have a W-8 BEN. Pre-FATCA rules, the W-8 BEN was provided by both an entity and an individual. Because payments subject to the FATCA regime require the non-U.S. entity to certify their FATCA status, that form was bifurcated. So now the W-8 BEN is only provided by individuals. It's a form where they certify that they're non-U.S., that they're the beneficial owner of the income, which means they're the ones that would take the income into account under U.S. tax principles. And if they're entitled to a treaty benefit, they would use that form. There's a specific section on that form where they're able to let you know that they're entitled to a treaty benefit. And then the W-8 BEN-E, that E stands for entity. That's going to be provided by a beneficial owner that is a non-U.S. entity that is claiming their non-U.S. status. And also, just like the W-8 BEN, there's a section there where they're able to claim treaty benefits if they are residing in a treaty jurisdiction. The W-8 ECI, ECI stands for effectively connected income, and that means this is a non-U.S. person. They're certifying their non-U.S. status. They're telling you, I'm engaged in a U.S. trade or business. When a non-U.S. person is engaged in a U.S. trade or business, they're taxed just like you or I. So instead of being subject to that gross basis taxation that we talked about at the beginning, they are taxed, they get deductions, they're taxed at the graduated rates. So in this case, they would not be subject to withholding. It would just be as if you were getting a W-9 from a U.S. person. You would allow them to have the zero rate of withholding, but then you're reporting on that 1042S that it's effectively connected income, and then just like the IRS matches our 1099s to our tax returns, they're going to be matching the income reported on the 1042S to the non-U.S. person's U.S. tax return to make sure that they've properly reported all of the income. The next form is the W-8 EXP. I wouldn't expect you to see a lot of this in the accounts payable world. This is a form from foreign governments and foreign tax-exempt entities claiming that exempt status under those different provisions that allow exemption for those types of entities. The W-8 IMY, that is provided by a non-U.S. person that's certifying, I am non-U.S., but I am not the beneficial owner of the income, meaning they would not be subject to tax on the income. Instead, they're acting on behalf of someone else. So either an intermediary, so they're a nominee or an agent acting on behalf of the beneficial owner, or a non-U.S. partnership or other flow-through entity, so a non-U.S. simple trust or grantor trust. They would be passing up the underlying beneficial owner documentation, so W-8 BEN, W-8 BEN-E, along with a withholding statement where, among other things, they're going to be allocating the payment to each one of the beneficial owners that they're acting on behalf of. And that way you, as the U.S. withholding agent, you're going to withhold and report in accordance with that documentation. So, I mean, you're going to report directly to those underlying beneficial owners as opposed to the intermediary. The oddball form here, so all of the W-8 forms that I discussed, the withholding agent collects the form, validates it, makes sure it's okay, sticks it in your file, and just keep it there in case you're ever under exam. The general rule is the form is valid for the year it's signed plus the next 3 full calendar years, with the exception of the W-8 IMY that has an indefinite validity period unless there's a change in circumstance. The Form 8233 is the oddball form. This is a form that's provided by an individual that has performed independent personal services for you, and they're able to claim an exemption under a treaty. This form they have to give you every single year. Instead of just sticking it in your file, you have to validate it. You have to send a copy to the IRS. You have to wait 10 days before you make the payment. If you don't hear back from the IRS within 10 days, then you can go ahead and make the payment with the 0% treaty rate. So again, just keep in mind that one has those additional hurdles that you have to clear, and also you have to get one from that non-U.S. individual every single year. So we've discussed all of this. Our starting point is the 30% gross basis taxation. If you don't have the documentation on file, there are mandatory presumption rules. So these presumption rules are going to apply to help you determine should I treat the payment as made to a U.S. person and 24% backup withholding, or to a non-U.S. person with the 30% non-resident alien withholding. The presumption rules, they are mandatory, and you have to follow them unless your actual knowledge is going to actually result in greater withholding and reporting, which is very rare. It does come up in rare circumstances. Try to move the slide. It comes up in rare circumstances, and that is because when these rules were drafted, the backup withholding rate was actually 31%, and then we know it went down to 28 and then to 24. So every once in a while, you'll get an anomaly where your actual knowledge will result in a higher rate, but generally that's not going to be the case. So onshore, so payments in the United States, the presumption rule is if the pay is an individual, it's going to be that they are a U.S. person, which means 24% backup withholding on U.S. and non-U.S. source income. If it's an entity, you would be looking for non-U.S. indicia. If you have a non-U.S. telephone number or the address that you would communicate to them is a non-U.S. address, you would presume them to be non-U.S., and it would be the 30% withholding. If you didn't have any of that non-U.S. indicia, you would treat them as U.S. One thing I know in today's environment, there often is not physical mail being sent, and the IRS has informally stated many times that it's the address you would use were you to have to send them physical mail. So if that address in your system is a non-U.S. address, then that would be it would be the foreign indicia, and you would treat that payee as foreign. And then again, I talked about if your actual knowledge results in a higher rate, then you would go with your actual knowledge. So that wraps up just going over the general mechanics of how Section 1441 works. Now I'm going to go over just some persistent misconceptions that we see. Oh, not yet though. Another polling question. How do you calculate the withholding? So is it manually in a spreadsheet? You're using a homegrown tool? You have a complete accounts payable automation tool that calculates the withholding? Or you don't, it's just not applicable for your business. I'll give you a little bit of time. let's see. So it looks like there's a good mix there. People are using all different methods there. Okay, just going back to these misconceptions that are out there. The first I'm going to cover with W-9. The first one is that the entity status must be completed, meaning they have to tell you that they're an individual, a corporation, or whatnot. The regulations actually say a valid W-9 needs to have a name, the TIN, signature, and date. So the other fields on that form are not mandatory. Now, it may be that you have to treat them as reportable, where they otherwise would have been an exempt payee if they had given you the proper information, but it does not invalidate the form. Another misconception is that there has to be address in the U.S. on the form. That's absolutely not true. As far as the IRS is concerned, certifying that you're U.S. is probably the worst thing that you can do. So it doesn't matter what that address is, U.S. or non-U.S. It's just irrelevant. And then another misconception, and this is a big one, the instructions to the W-8 form say that if the form isn't dated, the withholding agent is allowed to date stamp it on the date it's received. There is no such rule for a W-9. And as I said, the requirements are name, tax ID number, signature, and date. So if that form isn't dated, it's not valid, and you're not able to date stamp it like you can with the W-8. Then moving on to some misconceptions with the W-8 form. So first one, line 2 of that form is the country of formation on a W-8 Ben-E. And there's a misconception that it's always an error if that isn't filled in. That's not true. If the entity is a trust or it's an international organization, that line 2 would not be required. I want to point out one common other mistake with international organizations. The international organization status, Chapter 3 status on that form, means an international organization that is listed on the President's executive order. So it's things like the International Red Cross, the World Bank, things like that. Oftentimes, non-U.S. people, when they're filling out that form and they're an entity, they think, well, I'm global, and so I must be this international organization. So you got to make sure that if they're checking that they really are on that list, and it's not just that they just inappropriately completed that box. The next one, and this is a big one for accounts payable, and it's that the FATCA status is always required. That's absolutely not true. If you're making if the payment you're making is not a withholdable payment for FATCA purposes, which is really a FDAP payment that's financial in nature, they have carved out. It's called excluded non-financial payments, and nearly every payment you're going to be making through accounts payable is going to fall within this exclusion. That means you don't need the FATCA status on that form. You can create a substitute form. The regulations are very clear that you can create a substitute form, and I think the language is that satisfies the transaction. So meaning and the example they give is if you're making a non-financial payment, you can have a substitute form that removes all of the FATCA statuses and the Chapter 4 status certification, and the form looks almost just like the W-8 Ben that you used to know for entities, where it's, I think we have one that's just a little over one page. The next misconception has to do with the permanent residence address. The form says it cannot be a P.O. box or an in care of address, but there is a notice out there, Notice 2001-4, that says if there is a P.O. box on the form and the withholding agent doesn't know or have reason to know that the person is a U.S. citizen or resident and doesn't know or have reason to know that a street address is available, the P.O. box is fine. And that was that notice came as a request from industry because certain Arab countries, for example, don't have physical addresses. And then there's a lot of rural routes in Canada that don't have physical addresses. So if that's the case, that P.O. box is fine. You want to make sure, if it says, P.O. box, whatever, in Paris, France, something like that, there's physical addresses in Paris, France. So that would not be okay. So you've got to use some common sense there when you're going to accept that P.O. box. The in care of address is going to be a problem unless you've got documentary evidence to establish that it's the registered address for that entity providing that form. The other misconceptions as it relates to a W-8, all U.S. addresses must be cured. As part of the due diligence responsibility, if there's a U.S. address, the normal rules would require you to go out and get additional documentation to so-called cure that U.S. address or that anomaly. If the form, if it's a W-8 IMY or a W-8 ECI, we would expect on an ECI, that's that form where they're certifying they're engaged in a U.S. trade or business, we would expect a U.S. address on that form. And a W-8 IMY, that's the form where the person is certifying they're not U.S., but they're not the beneficial owner. It doesn't matter if there's any U.S. indicia associated with that form. It's just not relevant. And then the final thing here is that the affidavits can cure everything. What an affidavit is the regulations provide that if you didn't have the proper tax documentation on file at the time you made the payment, you can go get documentation after the fact to support the rate of withholding that you imposed. And they say that if you get that tax documentation within 30 days of the payment, you just need the tax documentation. If it's more than 30 days, up to a year, you have to get what's called a retroactive form, and that is the form is completed, but there's also an affidavit where the person providing the form certifies that the information was true and correct back at the time you made the payment. And that's the misconception. People always think, oh, I just need the retroactive form. No, if it's more than a year after the payment, so that means you're collecting the tax documentation more than a year after the payment was made, you need to get the retroactive form, but you also need additional documentary evidence to support the claims they're making. So if it's an individual, a national ID card, a driver's license, if it's an entity, organizational documents, or a residency certificate, something more to support those claims. And this is something the IRS is actually really hammering down on exam, that if it's more than a year, they want to see both that retroactive form and the additional documentation, so it's important. And with that, I'm going to move away from the 1441 rules and talk a little bit about this form 1099 NEC, that's non-employee compensation. So just to start out with and tell you a little bit about the history, this form is actually not new. We say back to the future. This form was originally released in 1979 and was used for several years. It was phased out in 1982. And it was for payments for the non-employee compensation. And after those initial years, the IRS decided it would be better to just include those in the reporting on the 1099 miscellaneous, so it would be combined with other reporting for royalties, rents, prices, things like that, so that you just had a single form. The problem that happened was there's a lot of tax credits that are based on the wages that are reported on a W-2 or the non-employee compensation that was on that box 7 of the Form 1099 miscellaneous. And historically, the IRS was approving over 90% of these refunds prior to the time, or actually within just a few weeks, and prior to the time that they were getting the 1099s and the W-2s to support the withholding that was shown on those forms. So we had fraudsters that were creating false forms where they were putting very low income amounts and very high withholding amounts, and they were submitting these refund claims very early on, and the IRS didn't have the information to verify the credit that was being claimed, and so they were letting all these refund claims go erroneously. So this changed. Congress changed this, in fact, in 2015. A legislation that was effected 2 years later in 2017 that said the IRS could defer paying out these refunds until February 15th. We still had the problem where the IRS needed that 1099 and W-2 information prior to the February 15th date. So what they did initially was they changed the due date for any Form 1099 miscellaneous with Box 7 information. So that was the information relating to the non-employee compensation. The Forms 1099 miscellaneous for all the other boxes in the income, so the rents and the royalties and those other payments, remain the later dates, the February or March dates. And this created just a lot of problems. A lot of people weren't aware that there was a new due date for any non-employee compensation that was reported on that form. And the initial year, the IRS did not assess penalties, but unfortunately they didn't send out a notice saying, you filed this late because you filed non-employee compensation. We're not penalizing you this first year. Another year goes by and the same mistake happens because people weren't aware that there was even this change. And so what happened was the IRS finally said, no, we're going to put back to life the 1099 NEC. So we have that new form. It has the January 1st deadline, and the January 1st deadline is both to the IRS copy and the recipient copy. And then all of the other information on the 1099 miscellaneous, that remains the same. You still report on that form, and it's got those February and March due dates. This is the first year that this is going to be reported. So for payments made, non-employee compensations made, calendar year 2020, this is the first year. So due next January 31st, actually I think it's February 1st this year because I think it's on a weekend. That's when this is going to be due. And here's just a look at the new form. It's fairly straightforward. And then I'm just going to go over when is this form going to be required. So the Form 1099 for non-employee compensation is going to be used if you make payments of $600 or more to non-employees for compensation, and then also it's going to be used to report any federal or state backup withholding. We'll get to some state issues in just a minute. So again, it's going to be anything that you used to report in Box 7 on a 1099 miscellaneous. For 2020 and going forward, it's going to be on the 1099 NEC. The IRS has issued joint Form 1099 miscellaneous and NEC instructions for the 2020 year, and just go through the variances there. So then there's some excluded payments. Of course, if its payment is less than $600, but of course there's an exception to that. If the payment was less than $600, but you actually did impose backup withholding, you're still going to have to file the form to get them the credit for the backup withholding that was imposed. Of course, it's going to be excluded if the payments are made to a non-U.S. person, as we just discussed a few minutes ago, that those payments are going to be reported on a 1042-S. If the payment is subject to 1099-K reporting, so services income that were reported on a 1099-K, those are excluded from the 1099 NEC reporting. And then payments to exempt recipients, so corporations in general. There's one thing to be wary of here. If you're making payments to a law firm for services, legal services that they provided, those are still going to be reported on a 1099 NEC. So a law firm, if it's operating in corporate form, it is not an exempt recipient for purposes of this non-employee compensation reporting. So you've got to make sure that you capture that. And then also we have excluded payments, and this would be expense reimbursement. So if you've got an accountable plan in place for the expenses that you're paying to these independent contractors, those expense reimbursements are not going to be reportable. It's not income to them. When I say accountable plan, I'm using that term loosely. It's had they been an employee, did you follow the right protocols that it wouldn't have been wages to the employee? It's that same process for an independent contractor. And then here's a problem that comes up a lot of times. If it's employees and former employees, so current employee, of course, all that is going to be wages reported to them on their W-2 form. The problem comes in, or the confusion comes in, when you're making payments years after the employment ended. And if those payments relate back to the employee, so it could be consulting, could be stock options or whatnot, that is still going to go on a W-2, not a 1099 NEC. And so you want to make sure that you're capturing those properly, because I think that's another problem that is very common. Now we're going to talk about some of the state reporting issues. So unfortunately, the states have not been up to speed with the new form. We're slowly seeing information trickle out. There's still a good handful of states that haven't announced anything yet. We are constantly calling them to see what they want withholding agents, payers to do with respect to reporting in this state, and those handful keep telling us, stay tuned, keep monitoring. The IRS has made clear in Pub 1220 that the NEC will not be part of the combined federal-state filing program for 2020, may not even be part of it for 2021. We just have to keep watching for that, but we know for a fact. And as I said, states are trickling out with information. Some states have said, yes, you can file the Form 1099 NEC directly to us. Other states have said we cannot process a Form 1099 NEC for 2020, so you're going to have to report that on a 1099 miscellaneous and send it directly to us. In either event, whichever way the state goes, you need to know, even if you're part of that combined filing program, you're going to have to report these payments directly to the state for at least 2020 and perhaps 2021, but fingers crossed that they'll be able to get all of that resolved by then. And again, we had the composite statements that's just not going to be available anymore. What that meant was if I made a payment of royalties and the personal services income, I had one form. Now it's going to be two, of course, because I'm going to bifurcate the non-employee compensation. This presents a problem for B notices. So if there's a name TIN match, now you're going to get two of the forms listed on that B notice instead of one. Which means those penalties can be higher, but hopefully once you go through the process, those penalties will be abated. And then the last point here is be prepared for some questions. The payees are not used to seeing a 1099 NEC. They're not going to know what it is. I know some payors are planning on sending out a letter ahead of time explaining or putting something on their website explaining. So if you've got a lot of payments going to these types of contractors, you might consider something like that just to avoid the inevitable phone ringing off the hook with them asking questions about this. So then I'm just going to go over some case studies just to hone in all the differences with this new form. So first, during 2020, your company's made $800 to a flower delivery service. And it's which form are you going to use for that? Is it going to be the 1099 non-employee compensation or the 1099 miscellaneous? We'll just go through, and yes, that's going to be the 1099 NEC because those are services that flower delivery service is performing. The next one is your company has paid $10,000 to an attorney in settlement for a slip and fall case in your office. And then same question, which 1099 would you use to report these payments? And this one, of course, is going to be the Form 1099 miscellaneous. It's a settlement payment that you're paying through the attorney. It had nothing to do with services that attorney has performed for you. And we've got one more. Your company has paid $1,000 for a law firm to update your human resource policies and procedures. The attorney that works, it's a legal corporation, and which form is required or no reporting. And that's going to be that Form 1099 NEC. If you remember, I had said that normally a corporation is exempt from this reporting, but that exemption excludes law firms that are operating in corporate form. And then we've got one final one. The CEO of your company took their spouse to a corporate board meeting, and there's imputed income for the spouse's corporate travel. And how is this going to get reported? So we've got the 1099 NEC, 1099 miscellaneous, or neither of those. And that answer, of course, is neither of those, and that goes back to that slide when we talked about what should be reported on a 1099 versus a W-2, and here the CEO is an employee, and that would be a W-2. And I think with that, I'm going to turn it over to Anand.
Thank you, Laurie, for the highly compelling and topical content. I know it was a lot to take in for the attendees, but the good news is that we are recording this webinar and it will be available to the viewers later. So in the next section, I will provide highlights about the Tipalti solution. Since this event is specific to tax, I will begin with our tax module, which is KPMG approved. And Tipalti solves the highly complex and manual process of collecting tax information through a digital capture directly during supplier onboarding, which does basically two things. First, it ensures that the tax information is collected, and second, it is validated before a payment is processed. So Tipalti's tax solution for U.S. payers simplifies the process and helps customers comply with IRS tax provisions. You can require all payees to fill out tax forms, the W-9s and W-8 variance forms, or provide their VAT and local tax IDs as a part of self-registration on the Tipalti portal. And our guided tax form wizard helps suppliers of U.S. payers select from the correct tax form based on their country and business structure. And once the correct tax form is selected, Tipalti digitizes the tax forms and applies over 1,000 rules, including 10 validation, to ensure that the proper data has been provided. And at year end, Tipalti generates the 1099 and 1042 tax prep reports and also calculates any necessary withholdings. In addition to the prep reports, we also support 1099 miscellaneous and 1099 NEC forms as well, which Laurie just covered. And for non-U.S. payers, Tipalti collects and validates local and VAT tax IDs in 49 countries. So this is the Tipalti wheel, which highlights our philosophy that if you put a robust system in place now, you will not outgrow it as you scale. So we provide an end-to-end solution to manage the entire payables operations. And it starts with supplier management that you see on top, with self-service supplier onboarding, which includes over 26,000 built-in rules and validation to ensure data integrity and ensure clean and error-free payments. As I highlighted earlier, we have a KPMG tax certified engine, compliance engine, that identifies and collects the correct tax forms, W-9s and W-8s, and also generates the 1099 and 1042 tax prep reports, including supporting the 1099 miscellaneous and NEC reports as well, and also calculates any necessary year-end withholdings. The solution, of course, includes invoice processing with OCR technology, machine learning, and managed services to ensure touchless or straight-through invoice processing, along with advanced approvals that is built in. We also have 2- and 3-way PO matching if they are PO-backed invoices as well. We are also a licensed money transmitter and pay across 196 countries in 120 currencies with 6 different payment methods. We do sanction screening to ensure that you don't pay anyone who's on a terrorist watch list or listed as a money launderer somewhere. We have robust AP reporting with more than 20 out-of-the-box reports and real-time multi-entity payment reconciliation with ERPs, which ensures faster financial close. So net now that you see on your screen is our built-in early payment solution, and you can generate revenue by paying your suppliers earlier without adding to your workload or impacting your working capital. The one last capability that I want to highlight is our FX or foreign exchange solution that you see below under Service Foundations. So you can save time and money and eliminate risk on foreign exchange or FX conversions with our FX hedging and spot rate solution based on your need. And it is ideal for companies with multiple entities or suppliers who are global and need payments or funds to be transferred in a different currency. And these complex and highly sophisticated solutions, which were not available to which were only available to large businesses, are now available to everyone. So hopefully providing a little bit of context about our solution. Here is a sample list of our customers growing from fast-growing startups to established companies across various industries that are benefiting from Tipalti. And our customer satisfaction rate is 98%, which is by far one of the best in the industry. And the ROI that our customers benefit from includes eliminating over 80% of payables workload with our current technology, reduction in payment errors by over 66%, the 26,000 rules that I talked about earlier, with all the intelligent data and payment validation rules that are built in, and then accelerating the financial close by 25% or more with real-time reconciliation with ERPs, such as NetSuite, Intact, and QuickBooks Online. We are also developing many other ERP integrations with Microsoft Dynamics, NAV, GP, Dynamics 365, Business Central, and different versions of Sage, X3, 100, and 300 as well. So hopefully that provided you some information about our capabilities. Before we move to the Q&A section, just a quick reminder on the CPE requirements. So if you're interested in receiving the CPE credit for today's webinar, please ensure that you meet the 3 criteria. You have to watch the webinar for 15 minutes. You have to complete all 3 polling questions. And you also have to complete the course evaluation, which is referred to as Pass Test in the webinar console. You can access the course evaluation by clicking on the icon in the toolbar at the bottom of your screen. And as I mentioned earlier, we will keep the console open for 10 minutes after the end of the webinar to give you enough time to complete the evaluation. So with that, I will open it up for Q&A. Laurie, there are quite a few questions. In fact, many questions, and let's see how many we can cover in the 15-minute remaining minutes that we have.
Yep, sounds great.
So, Laurie, the first question, do we have to report 1042-S for C Corp?
Yes. So unlike the 1099, where there's exempt recipients and de minimis thresholds, payments to non-U.S. persons, there's no exception from reporting if it's an amount subject to withholding, which was all of the FDAP income I talked about. So the payee doesn't matter. There is no such concept as an exempt recipient. And, other than the instructions to the form saying that you round, there's no de minimis threshold. So meaning, like, if you're at $1, you would still technically have a responsibility to withhold and report.
Next question, Laurie. Does a signed W-9 form need to be updated with the current year every year?
Oh, great question. No, the W-9 is valid indefinitely absent a change in circumstance, which is very rare. I guess there are circumstances where a U.S. person would renounce their citizenship, but that's going to be extremely rare. And so even when the form series changes, they come out with a new revision, you do not need to go update your W-9s. So once you have them, you're pretty much good to go indefinitely.
Are you able to send a 1099 and W-2 in the same year? For example, a consultant becomes a permanent employee.
Yes, that's exactly right. So I had discussed the flip of that where I was saying, no, it should all be on the W-2, but that is exactly right. If they're a consultant first, an independent contractor, not an employee, for a portion of the year and then become your employee, you would be bifurcating that, and with part of it being on the 1099 when they were the consultant and then the rest being on the W-2 once they were employed by you.
Got it. This is a two-part question, Laurie. So non-U.S. person income, how do you define the source of income, and is it solely based on where the service is completed?
Yeah, so for services income, that's exactly right. It's where the services are performed. For royalties, it's where the intellectual property right is used. For rent, it's where the property is located. Interest and dividends, it's the source is the residence of the payor. One thing that I should have brought up earlier with respect to the services, the presumption I mentioned in the regulations, if you can't establish the source, the presumption in the regulations is that it's U.S. source. What the IRS is looking for on exam, they want it in your contract, your statement of work, or on the face of the invoice that all services were performed outside the U.S., or if some were performed inside the U.S., an allocation of inside and outside. If that's not the case, I know a lot of us anymore, there are no invoices, it's all electronic. And if it's not in the contract or statement of work, then you're going to want to get what I call, for lack of a better phrase, a service statement. And so an email is even fine, but where that service provider tells you, I have performed all the services outside the U.S. What some people have done, and I think this is actually a good idea, and it does hold up well on audit as long as you follow it properly, is to actually put in your contract with non-U.S. persons for services, all services will be performed outside the U.S. unless you notify me in writing and tell me when you're coming to the U.S. And as long as I think the best thing to do is have a designated email box. You can't just say, as long as you let me know, because the IRS is going to say, how would I possibly know if this person, contacted this company and gave you that information? So they want to see either a designated contact person or a designated email box where that non-U.S. person could actually come forward and say, yes, I was in the U.S. for 10% of the time. So you might think about something like that, because that is something that the IRS is very, very focused on in exam.
On similar lines, Laurie, if our work is performed outside the U.S. entirely, do we still have the requirement to file 1042 and 1042-S?
No. So if all of the income is non-U.S. source, because for payments to non-U.S. people, the starting point is always it's just U.S. source income. But what you want to do is first get that service statement or whatnot that I just talked about, so it's clear that all services were performed outside the U.S. I had said that the presumption rules are normally designed to hurt you. There is some exceptions there. If it's an individual, there's a presumption that if it's non-U.S. source income for services performed outside the U.S. and the withholding agent doesn't know or have reason to know that the individual is a U.S. citizen or resident and don't know or have reason to know that the income is effectively connected to U.S. trade or business, you can presume that individual to be non-U.S. That's the only exception to the normal presumption that an individual is always U.S. I recommend that you have tax documentation requirements and use those rare instances where the presumption rules help you as a safety net. It's really hard to train accounts payable people. There's often a lot of turnover in that area. They move up onto different places within the organization, and to be able to train people to know when you need a tax form and when you don't. And a lot of times vendors, non-U.S. vendors, are going to push back and say, nobody ever asked me for this. So if you just have a company policy, that's helping your frontline people there that are facing off with those vendors to say, I'm really sorry, it's a company policy. We can't set you up in our system without a tax form. Just makes it easier. But once you've got the certification that it's non-U.S. and you've got the certification, the tax form that they're non-U.S. and the services are non-U.S. source services, now we have no withholding, no reporting because it's non-U.S. source income paid to a non-U.S. person.
Staying on 1042S, so for 1042S, it does not require us to provide foreign corporations, right? Only applies to individuals and partnerships similar to that of US 1099.
No, so that's going to be, again, the 1042S, the payments to non-U.S. people, the reporting is going to be irrespective of in what manner they're operating. So corporations are still subject to withholding and reporting on the 1042 and 1042S.
Got it. Would W-8 ECI be used for international vendors getting income on revenue share invoices?
I wouldn't think that would be the case. I mean, it's going to depend on exactly what the revenue share is and what that non-U.S. person is doing to earn their share of that. But I would normally not think it was from activities, of a U.S. trade or business by that non-U.S. person. But you'd really just have to look at each contract to determine that. And here's one thing that's important. I think people get confused a lot. Like, should this be a W-8 ECI or a W-8 BEN-E? It's really up to the payee or the beneficial owner to be telling you what their status is. So you're able to rely on the certifications they make unless you know or have reason to know that they're not correct. You're not an investigator for the Internal Revenue Service. You don't need to go out and get more information than what you normally get for your business transaction. That said, what you do get for your normal business transaction is all fair game, and so you need to vet that information against the certifications they're making to make sure that there's not any anomalies there. But they should be telling you by giving you the W-8 ECI, this is effectively connected with my U.S. trade or business, or that it's not, and giving you the W-8 BEN-E and claiming a treaty benefit if they're so entitled.
So someone is asking, Laurie, if they can process a payment to non-U.S. persons or entities with no withholding certificate as long as they withhold 30%.
Yeah. So you can always, there are treaty benefits available, and the non-U.S. person would give you a W-8 BEN if they're an individual or a BEN-E if they're entitled to a treaty benefit. You as the withholding agent do not have to reduce the rate of withholding if you're concerned about that. Now, you may have some customer relationship issues if they're entitled to a 0% rate, for example, an entity that gets the zero rate under the business profits article in the treaty. But the regulations are very clear that a withholding agent may reduce the rate of withholding if they get the proper tax documentation. It's not a must. You can still say, I accept zero risk, because as a withholding agent, there always is risk. If it's not done right, as I said, the liability becomes yours. So if you just want to have a zero risk operation, you can always just say, I withhold 30% on every U.S. source payment I make to a non-U.S. person.
Has the criteria for 1099 NEC changed? What type of vendors would get this?
Okay, so no, the criteria hasn't changed. The only thing that changed is when you're paying an independent contractor for services that they performed, you don't report those on Box 7 of the 1099 miscellaneous anymore. Instead, you pull those off if you were reporting multiple types of income, and you report that non-employee compensation, so that independent contractor services income is now going to go on the 1099 NEC. And again, that's got that earlier January 31st due date.
I think this is a little bit of a generic question, Laurie. So we make payments to individuals outside of the U.S. for work performed outside of the U.S. These individuals are beneficial owners. What type of documentation would you recommend?
Okay, so for that, I would ask for, if it's not clear in the contract or statement of work that all services are performed outside the U.S., I would want them to certify that to me. And again, an email from them is perfectly fine. And then for it's an individual, I would want a W-8 Ben. They just need to fill out the Part 1 and sign and date it. Obviously there's no treaty claim because it's going to be non-U.S. source income. As I mentioned, we do have that fallback, that presumption rule. But again, I really think it's important to, best practice to use the rare instances when the presumption rules help you as a safety net, as opposed to business as usual. And I would suggest getting the W-8 form where they're certifying their non-U.S. status.
We have time for a couple more, Laurie. So the next question is, so what is the form number where you have to hold off on payment until 10 days have passed and no IRS communication?
Right. So that's that oddball form, the Form 8233. And that's going to be provided by an individual that's resident in a treaty country that exempts independent personal services from taxation. And so that's how they claim that treaty benefit. And that, again, unlike the other forms that are generally valid for the year signed plus the next 3 full calendar years, that 8233 is only valid for 1 year. So if it's a individual that's performing services for you over the course of numerous years, you're going to want to update that form every single year, and then that's where you have to go through that additional validation process by sending it to the IRS and waiting that 10 days.
One more question, Laurie, before we get to the final one. So how about payments to restaurants that provide food to our clients? Do these go in the NEC slot?
No, so if it's for food, if what they're charging you is just for food, that would be goods, and so that's not reportable. If there's services with that as well, if they're catering, if they're delivering, things like that, that would be different. But if it's just the purchase of food, that's not reportable.
Right. Before we conclude, Laurie, so this is the end of the year. Basically, what are the top 3 things that companies can do, just the best way to stay on top of tax regulations to make sure that they're compliant and then they sleep better at night? Do you have any recommendations, any top 3?
Yeah, I think, unlike the payments to non-U.S. to U.S. persons, you either have the the TIN, the tax ID number, in the manner required. So whether that's a W-9, which I always recommend regardless of the payment type, or just the TIN if you don't need the W-9. You can't cure that after the fact. If you make that payment without having the TIN on file, you should have backup withheld, and you're liable for that. The only way you can get out of that liability is to go ask that payee for a Form 4669, which is an affidavit that they reported the income and paid the tax. It's a very awkward conversation with a vendor. So you don't want to get yourself in that position. But so always making sure on the U.S. side that you've got that tax ID, and maybe have a system where if a lot of people don't have a system that can actually impose backup withholding. So what they will do is hold payment. So, to the extent the contract doesn't say that you're not permitted to do that, I don't want you to break a contract. But hold that payment, that gets their attention, and then you can get the tax ID before that payment goes out, and you would be okay. On the non-U.S. side, you can remediate after the fact. I had talked about the if you get it within 30 days or the retroactive form if it's more than that. I would suggest going through and sampling the payments that you're making to non-U.S. persons and looking at the contracts and determining the character and source, and then following it through to the tax documentation and the reporting, making sure you did all that right. Because if you didn't, you want to correct that before you're under exam, and we know the IRS is very active in this space. So, you can amend reporting if it's incorrect. You can go get tax documentation if what you had wasn't valid or if you don't have anything. So on those payments to non-U.S. persons, that's all fixable. So I would recommend definitely that you go through that exercise. And then just the last thing, always make sure you're using the latest versions of the IRS forms. We are expecting some additional updates because of some regulation changes. It's not going to affect the forms you currently have on file, but the general rule is you need to be using the latest version of the form within 6 months of its release date. So you want to be watching for that. The IRS website, if you just get on there every once in a while, it's going to give you what's new, and you're going to see that. And then also just monitoring the due dates. We've seen the NEC, the due date change. Just make sure that you're on top of these due dates to make sure that you don't get penalties just for something like that.
Great advice, Laurie, and thank you for the fantastic presentation and for responding to the audience questions. So we are at the top of the hour, and this concludes today's webinar. Thank you, everyone. We appreciate you being here. And we were not able to get to all of the questions, and we will get back to you shortly and respond to you within the next couple of days. And as I mentioned earlier, we will keep the console open for about 10 minutes to give you more time to complete the evaluation. Just a quick reminder that the link of the recording and the slides will be in the follow-up email that you will receive tomorrow. Thank you, everyone, and have a great rest of the day. Stay safe.
Great. Thank you. Bye.
Thanks.